All right, guys, how's everyone doing? We're scheduled to do a group mentorship session next week, but we're going to move it up a week, and we'll do one next week as well. But give me a shout out here. We got a big turnout. Let's see who's here. Today, we're going to talk about the three types of stocks in the what we're going to call now post bear market. We've been calling it a bear market. We're going to say post bear market now, and we're going to do a little bit of a review because there's some new people here. We've got our regular group mentorship with our swing group here, and also we've opened it up today. So I know there's a lot of new traders who might not be familiar with what we're doing here. We got a lot of pros here who are going to help you out. So we'll get to it in a few minutes. We'll wait for everyone to get in here. But we're going to talk about basically the split, and it's a three-way split. At the beginning of the bear market, we had it split to what we've written here: relative strength, Corona stocks, and the beaten downs. And it's changed a little bit here. So we're going to talk about that, how we're looking at the market a little bit differently. Pretty similar, but there are some changes now going on. So we're going to do that. We're getting into the next earnings season. It feels like we just got out of one. So we're going to get into the next earnings season. And we're actually going to do a swing trading little mini earnings season class that goes really deep, in depth into earnings, much like we did with the bear market class. I know a lot of you here took that. It was really well received. And just like with the bear market, we're going to talk about stuff that you don't see really anywhere or anybody talking about related to earnings. I'm even going to get into a little bit into options, which we don't talk a lot about, but I do use as a hedge during earnings season. So we're going to talk about that a little bit. Then we'll do our normal Q&A that we always do with the group mentorship session. So any questions you guys have, get them ready. We'll talk about whatever you want and get into some mentorship. But as usual with the mentorship sessions, we always start with a lesson, and we're going to talk about the change in the split. Now, you guys have heard in the report, that we've had a little bit of a change. You probably picked up on it, although I haven't really laid it out in the sense that relative strength, Corona, and beaten downs have changed a little bit, because some of the beaten downs are actually turning into relative strength, and some are still beaten downs. Some of the Corona stocks are lower, some are higher. So we're going to talk about how we're looking at those, and we'll wait a few minutes here. Looks like a couple of you here are having trouble hearing. So let me know, guys. Can you hear me and see me okay? As usual, give me a shout out here. Let me know where you guys are from. Always do a book recommendation before any one of these types of things. I'm going to do the same one I did last time, and that's Fooled by Randomness. This one takes a little longer, so it looks like the sound is okay, good. And I know after I recommended this, a few of you picked it up who hadn't read it yet. I know a lot of people have read it. I read anything by Talib here, but this one is really good. This guy was a hedge fund manager, so and he's done really well. But it's a lot of the talk here is about uncertainty and how to manage uncertainty, and obviously that works really well with trading. So I'm reading this one really slow. I usually read a book a week, but I think this has been about 2 weeks because I'm taking a ton of notes on this one, even though it's probably the 4th time I've ever read it. But really good book here. All right, let's see who's in here. A lot of the usual suspects here. What's going on? Juan, Clarence, Skip, Rich, what's going on? I've worked very closely with Rich. Gabriel, Steven, Nick. Let's see here. John. I don't recognize John. Are you a new member, John? Or have you been in one of these before? For some reason, I don't remember your name. Steven, Navneet, what's going on, Navneet? Dan, Hashim. The list is actually too big for me. I usually like to call out everyone, but the list is too big here. But welcome everyone. Let's get to it. Let's talk about this post bear market right now. Let's actually review what's going on with the market. So we had this huge move down, and it's amazing. We're only in June. This was only a few months ago, but it feels like an eternity ago. I guess this whole quarantine has just felt so long that, gosh, I can't. This does not feel like yesterday. It does not feel like only 3 or 4 months ago when we had the big move down. But we hit that bear market here. Technically, a bear market is when we're 20% off highs, and as you can see here with SPY, we're almost back up to all-time highs. So can't really, even though we're in this quarantine mode and the economy stinks, stock market is not in a bear market. We're back in bullish uptrend here. So we're not calling it a bull market, bear market anymore. It's bear market turned bull. So we're kind of back in a bull market here. This has been a very strong market. So that's basically where we're at. And the split that we were initially doing, and you guys know as we've traded through this quarantine here, we broke everything down. Basically, as we were coming out of the bottom, we basically broke everything down into Corona-related stocks. Those are stocks that have done and were expected to do very well during this whole quarantine and coronavirus kind of market and world that we've been in. So, and that goes for work from home type stuff, exercise from home type stuff, basically anything you could do from home, medical from home. Then the discount stores, grocery stores, Amazon, that type of thing, drug companies, obviously. So all of those things related to what we created. We created this Corona type, our own little ETF here, about 35 stocks, and that list is right here. So a bunch of different stocks here related to basically those three different things we talked about. So we had that list. Then we had the stuff that was really beaten down, that got crushed because of what was happening, because of the economy closing up. And a lot of that related to retail. Retail got hit really hard. Anything in hospitality, casinos, resorts, hotels, anything related to oil and energy, because we weren't traveling around. So, and some other areas, obviously, but those were the beaten down. So areas that got really crushed. Everything did get hit, but really crushed during this period. And then we also had our relative strength. And those were the stocks. Some of the Corona is in relative strength, but stocks that held up really well and didn't get quite as beaten down. We can even think of the FANG stocks. FANG stocks did get hit, but not hit that hard. So we basically have broken down the stocks we're watching, where we normally do our sector analysis, and we break down all these sectors, and there are 140 different areas we're watching. Here it was basically divided into three. You're either a Corona stock, you're either a relative strength stock, you're either a beaten down stock, and if you don't fit these through areas, we weren't really even thinking about these stocks, because this is where the major moves and the major setups were coming. And now that's changed a little bit. Still, we still talk about these areas, but it's interesting that some of these beaten downs that were crushed have actually moved from beaten downs to even relative strength stocks now, or they're in the middle rather than at the bottom. So we've done some adjustment here, because we could call some beaten downs, but we can't call some of these beaten downs anymore because they're at highs now. So the way I'm looking at it now, I'm still not doing my normal sector analysis where I break down 140 the different areas in TC 2000 or industries. Now it's basically stocks near their highs, and it's interesting because some of the big tech in those areas are still near highs, but it's also some of the stuff that was hit and was this beaten down are now at highs. So now I'm breaking it down, not necessarily beaten downs versus relative strength, but we're looking at it, which stocks are near their highs, which stocks are basically at the middle stage, and that would be the 200 moving average. And you guys know, as we go through the stocks every day, we see a bunch of these that we've been talking about that could be setting up that are right at their 200-day moving averages. So we're going highs, stocks near their 200-day moving averages, and then the stocks that were beaten downs, and while most of them are not at the bottom anymore, so they're not necessarily beaten down, they haven't really come out of that bottom formation too much. So I'm calling those, we'll call them BF here, bottom formation in play. So they haven't quite reached that 200-day moving average, but they're still bottom formations that look like they could break out. And we're talking mostly airlines here. Most of the airline stocks are still at that level. They haven't quite hit the 200 MA, but there's a mix. There's some retails that are highs. Some retail are at their, almost all the retails were beaten downs, but now some of them are at highs, some of them are in this middle range, and some of them are still bottom formation. So we look at this list here and just think about retail, where they were all bottom beaten downs before. Now we have something that like Lulu, which is at highs. We have something like Ulta, which is at the 200-day moving average. And then we have one like, we could say Kohl's here. Didn't put it on the list, but Kohl's, which is another retail, which would be bottom formation in play. So it's not necessarily now all retail is beaten down. Now we have a real split here. So we're thinking about these splits. So I think that's the way we should be looking at the stocks we're trading. And basically, everything I'm trading relates to these three things, especially now that, we're out of earnings season, where before, if you had an earnings specific stock, you could go outside of this. And we have earnings season coming up in about 3 weeks, early to middle July. And once that hits, we can add some stuff out of these areas that are just based on the news event that they're getting right at that point. And then we can trade them as earnings plays, which we'll talk about here. So, but right now, it's basically this split. I have stocks near highs, middle, and lows, and then we're trading the setups related to that. And there are different setups we can be trading at these levels. So for instance, bottom formations, we're basically doing nothing but trading breakouts or continuation patterns out of those bottoms. 200-day moving averages, we're basically trading the 200-day moving average break. And then highs, we can be doing one of two things. We can be trading continuation patterns when they break their highs, or when they get really extended, even though they're showing a lot of relative strength, we can actually be shorting those things for runner shorts. And we've done a couple of those recently. So that's basically the way we're looking at the market. And now let's look at some examples here so we can really see and visualize what we're talking about here. So let's take the highs first. So we have stocks that are showing a lot of relative strength. They've done fantastic, throughout this whole quarantine, coronavirus period. They've done really well. Haven't been hurt at all. Well, let's take Tesla. And those of you that are in the swing service know we are in Tesla right now. Tesla actually did get hit. I would say it was relative strength though, because it did not break its 200-day moving average and bounced back very quickly, and now is at all-time highs. So we have Tesla here is a good example of one of them actually, let me backtrack a little bit. Let me go back to the indexes, because the indexes kind of reflect what we're talking about here with highs, 200 moving average, and bottom formation. If we look at the Qs are showing that high. They're at highs right now. Then we have SPY, which is in that middle zone. It's off the 200-day moving average now, but this is kind of that, if we split it into the Qs are highs, the SPY is this middle range, and then IWM is still below its 200-day moving average. So that would fit kind of this, the three indexes actually fit this split. Highs would be Qs, 200-day moving average would be SPY, and then bottom formations in play is the IWM here. Okay, let's get back to the stocks we're watching. Tesla, BYND, another one that we are in right now that has worked really well. This one is interesting because depending on where you go from it, if we're talking about way back in last summer, it's not at the highs yet. But when we say highs, we're talking about where it was before, the big meltdown, and it actually is above its high before the big meltdown. So this would be highs as well, even though there is a high from last summer above that. I consider this breaking highs right now. We have Zoom, Work. These are both Corona related here, and you can see here work from home. So you can see Zoom here, obviously has been very strong. And when I look at relative strength, one question I'll always ask myself, like, if the market is tanking and I didn't know that, if I didn't know what SPY was doing, didn't know what a bunch of stocks were doing, and I just looked at this chart, would there be any indication to me that the market had tanked? And the answer is no here. I would never know that the market has tanked. So that obviously that shows that it is showing relative strength. So we have Zoom here, obviously on the list. We have Work here, which we actually entered today on the gap down reversal play, but has shown relative strength here, is near highs, has broke the old high here, obviously pulled back and there was a gap down, but this is still near highs here. We have Snapchat, which broke highs actually a couple of weeks ago and is in all-time high territory right now. We have Spotify, which has just been on fire with all the podcasting news today. Back here was Joe Rogan news, and then we had more news today. So Spotify, obviously, really strong relative strength. And then we'll go over a few more here. Lulu and Crowd, Twilio and Crowd. So Lulu, the retail we talked about, is coming right off highs here and has broke the high before the big bear market meltdown, and then CRWD. So these are all examples of stocks that we're looking at as relative strength stocks. And then we trade setups accordingly, basically trading pullbacks or breakouts of highs. So Those are the relative strength areas or highs. And then we have the stocks that are at their 200-day moving averages. And they can either be right at the 200-day, they might have already broken or a little above, but still way away from their highs, or they might even be a little below the 200-day moving average, but way off the lows and have broke out into continuation phases. So these are all good examples of that. So let's start off with Disney, which is not quite at the 200-day moving average yet, has tested it here, pulled back, and looks ready now to make another test of the 200-day moving average. So this would be one that's right in that range. Maybe not breaking over that yet, but is right in that range. We have BBBY, another retail stock, right at that 200-day moving average. So it's not stuck down here like, say, some of the airlines are, just barely out of the bottom formation, but actually has broke out of that bottom formation and is now ready to at least test the 200-day moving average and maybe make a run to highs. And these are the stocks I'm actually most interested in right now. The ones that have broke out of the bottoms are testing that 200-day, because once they break this level, I think that the highs are in play and they could move very quickly. This one could move very quickly once it breaks there from 11, up to 17 here. So these are the ones I'm really focused on here. BBBY, we have Pinterest, we have Twitter, we have Ulta. So let's take a look at Pinterest here. Already broke over the 200-day moving average. You could be in this one right now. The 200-day moving average is actually pretty new here because this is a recent IPO. And this is another one where not at all-time highs, but when we say highs, actually this isn't a highs one. This is a break of the MA. But if you're thinking about the highs, I would be looking at two areas. This area right here, 27, and then this area here at 36, which also is the IPO high. It recently IPO'd here last year. And these IPOs can move very quickly towards their highs. So I really like Pinterest here. If I didn't already have 5 or 6 positions, I might be in this one right now. But if you're looking entry, since it's already above the 200-day, you could enter here, place a stop under the 200-day moving average, maybe about 3 points, 2 or 3 points, and then you could have a target up here around, probably needed a little higher than 27. But there's still a lot of room to the upside. We have Twitter, Ulta, Uber. So let's take a look at Twitter here. Same thing. You're going to see the same setup over and over again. This one, got beaten down, bottomed, and now has broke out of that bottom formation and now has crossed over the 200-day moving average. So again, this is that example of over the 200-day moving average, not at the highs yet, a lot of room to run before it hits that high. Uber, same thing. And Uber's closer to it. Its high is not actually that far away from its 200-day moving average, but still a lot of room. You could enter here, a place of stop of about 2 points, and you've got about 7 or 8 points towards the target or the pre-bear market high. Let's look at 2 more here, Starbucks and FSLR. Starbucks here, also, this is a lot like Disney. Made that test of the 200-day, pulled back, and looks ready to make another run here at that 200-day moving average. Breaks that 200-day, you could use that as a setup and then play it to the pre-bear market high. And that's where I'm targeting a lot of these. The ones that break the 200-day moving average, a good target is the pre-bear market high, which isn't too far away. And then finally, one more, which would be FSLR. Solars have been in play recently, and this is right at that 200-day moving average. And you can see where the pre-bear market high is around 60. So we have the highs, we have the 200-day moving average, and then we have the bottom formations. And this is a lot of airlines, some retail that aren't in these 2 phases, a lot of restaurants are in this. They've all put in these bottom formations and have made nice moves, but haven't really made that secondary run that these guys have that are at the 200-day moving average. So let's just look at a few airlines and some of these retail here, maybe a restaurant, UAL and BA. We've been watching these for months now, and you can see here, they've put in the big bottom formation. Initially we thought they were ready to really break out, but they've pulled back now. And now these guys look ready for their next run to that 200-day moving average. So there's actually really good risk reward plays here. UAL, BA as well. We'll pull up RCL, same thing. We have the casinos here, putting in the same pattern, a little closer to the 200-day moving average than say the airlines are. Then we have restaurants like Cake, and EAT. EAT is actually closer to its 200-day moving average. And then we have Kohl's, some of the big box stores here. Let's go Kohl's and Macy's here. So Kohl's here, a lot of room to the 200-day moving average as well. I'd be a little more concerned with Kohl's because even as it's bottomed here, you guys know we look for accumulation and distribution. So we basically want to see, as it's bottoming, as it's breaking out, we want to see a lot of big green candles. We don't want it, which means it's being accumulated, especially by the big guys. When you see this kind of volume, 20 million, 10 million, we don't want to see a lot of big red, and that's a little bit concerning with, say, Kohl's and Macy's. But whereas, say, UAL, we're seeing much more bigger green. Same with BA. We're seeing a lot more of the bigger green candles. So that's the way we broke it down. Now it's not necessarily now relative strength, corona, and beaten downs. It's more relative strength highs, maybe relative strength off bottoms with the 200-day moving average, and then the ones that are still kind of in these bottom formations. So we have it broken down into these three areas. Basically, all of our setups and trades are coming out of these three areas. And what I've been trying to do is get a mix of them. And you guys know this from our kind of portfolio of stocks we're trading right now. I don't want to have too many in one area because these areas tend to move together. So, you know, I'm trying to go for some stocks that are relative strength, some stocks that might be the beaten down, some that are towards the 200-day moving average, because it helps non-correlate your portfolio. So if all the relative strength stocks get hit one day, maybe the beaten downs are doing better. And we've been seeing a lot of that, where certain days the beaten downs do really good, certain day the relative strength does really good. So, you know, we've got Tesla as a relative strength stock. We've got BYND right now as a relative strength stock. And today we entered Work as a relative strength stock. And we have, as a bottom formation right now, we have UA. I think I'm forgetting one stock. We're also in Google, which would kind of be towards the highs as well. Maybe I could add a little more of the 200-day moving average type plays, but a lot of them are just under that level, and I'm watching and waiting for a few of these to break over those levels before I enter them. But I'm going to try to get more of a mix with that. All right, so that's what I wanted to go over today in terms of the mentorship lesson for today. And that's basically how we're looking at the market in terms of the switch from beaten downs, corona, and relative strength. And we'll get to the mentorship questions now. So if you've got any questions, put them in the chat and I'll start going through them. In the meantime, as you're writing your questions, really quick, we have earnings season coming up. So, you know, it's going to start around early July and then it'll really get underway mid-July. Before that, like we had the bear market class, which a lot of what's happening right now has played out exactly like we talked about in that bear market class. You know, we broke it down into the different past bear markets we'd seen, going back to the Great Depression, all the way to the most recent big one, which was 2007, 2008. And we laid out these scenarios, and the 1987 scenario is kind of playing out right now. And the setups we talked about in that class have played out perfectly during this period. So much like that, we're going to do an earnings class now, where we're going to go really in depth into earnings. I talk about some of the strategies in the swing report, and you guys have access to the swing report class, and I talk about some of those setups in there, but we're going to go into it a little deeper. So I think I've got here laid out some of what we're going to talk about here. And one of the big things is we've always talked about not entering before earnings because we don't have much protection and it's basically gambling through that. I'm actually going to go over some option strategies that can help protect you, both if you're only trading options and also if you are taking a regular swing, some option trades you can take to help protect you with that. But we're going to go really in depth into analyzing earnings, exactly how we play it. You can take a snapshot of this if you want a layout of what we're going to talk about. So if you are interested in that, go to this link right here, and it has all the information about that class. All right, let's get to your questions here. Jazz is asking, what is the 200-day moving average? Okay, if you're a new trader, new to technical analysis, good question. Moving averages are important. So what the 200-day moving average does, it basically takes the last 200 days of trading and it averages out where price would be, and that is the 200-day moving average. Now, on its own, it's actually meaningless. What's really important is what price action, where the actual buying and selling has taken place. So for example, if we're looking at BA, the 200-day moving average is way up here because of all this price action in here, and it's going back 200 days. Really doesn't apply right now because this is where all the buying and selling is. These are the support levels that are important to us, and the price action that's important to us. But these levels become very important because traders are trading around them. The 200-day moving average specifically became in vogue in the 1980s because the institutions started trading around the 200-day moving average, and they still do. So a lot of institutions will say basically a stock is in a bear market if it's under the 200-day moving average, bull market if it's above the 200-day moving average. Some people will not go long unless a stock is above the 200-day moving average. I don't subscribe to that theory, but it's good to know that. So there is a lot of trading around these moving averages, and you'll be surprised at how strong these can act as support and resistance. I mean, look at, over the months in here, how price action here would go right up to these levels and pull back. That's no coincidence. There's a reason this is happening because traders are trading around those levels. So that's kind of the short answer to what is the 200-day moving average. All right, let's see, Gabriel. With this kind of crash on stocks, will the next earnings season affect the market? Great question, Gabriel. I think this next earnings season is very important. One of the most important earnings seasons we've had in a very long time. And that's kind of why I did this class. I've never done a class for earnings specifically before. That's why we're focused so much on it right now. We have our normal setups. We trade around earnings, but specifically coming out of quarantine here with all the stuff in place to get the economy going, we really want to see an improvement in earnings for the market to really break out here. So, we've had this kind of initial catalyst for the market to run up, and I think this is going to be the second catalyst. So this earnings season is going to be very important. If it is not good, I think it actually is going to be good if I were to guess, but we're not going to gamble and take that shot. We want to see what happens. But if it is not good, I think we're going to see the next big wave down. I mean, you can see with something like X today, just their guidance today impacted all of the metals. And I think that's going to happen across the board if we start to see more and more poor earnings reactions. Okay, John is asking about work as a trade we took today. And he's asking about the volume. And I think your question is probably related to the gap down here in the big volume. So we think about accumulation and distribution, and those of you who are Swing Report members, if you're still unsure about accumulation and distribution and volume, go into the class you guys have. We lay it out in there. But when you're thinking about accumulation and distribution, you want to be thinking about overall pattern. 1 day or 2 days doesn't make distribution or accumulation, especially when it's related to one news event or one gap down. So yeah, this kind of big red volume is not what you want to see in an uptrend, but we have to keep in mind it was a reaction to 1 day's news. And then there was a specific setup that we trade, which is the gap down reversal. And I think that setup is in that class you guys have. So anytime you have a big gap down, you are going to have big volume coming in. But we like to trade these gap downs to the long side because these gap downs tend to be overreactions. And when they pull into the gap, that is a very strong signal that the stock is going to run and that this was an overreaction. So right now, I'm discounting this volume here. Now, if it were to start to run here and maybe it did a pullback and then we had big volume again, then I would start saying maybe it's distribution. Now we have a pattern. It's not just a one-time event, it's a pattern. So right now, don't really care about it. If it happens again, in about a week or two here, maybe the stock pulls back and we see big red again, then I would be concerned. Greg is asking, Zoom trades at 84 times sales. Are forward-looking projections realistic? Greg, that's something you might want to pay attention to in terms of fundamental analysis, especially if you're trading this long term. But for a short-term swing trader, we really don't care about that stuff. It has absolutely no impact on the momentum if we're going to enter, a trade for the next 2 or 3 weeks. So it's been extended for a while, but it keeps going up here. So we don't care about that at all. All we care about is the technical analysis and the setups that we trade. Sean, you gave me your email, looks like, but I'm not sure why. So give me what you want related to your email there. All right, Bruce, what do you mean by stop loss 2 points? Do you mean two? Yeah, when I say points, I mean $2. The reason I don't say dollars is because people then will get confused that it's the dollar amount of the trade. So like for work here, I think we have a 2 point, I say a 2 point stop. If the entry was at 34, that means the stop is at 32. All right, I hope I'm pronouncing your name right. Sword, is that how you pronounce your name? Wants to know if I've changed anything in my strategy now that the market is more volatile. And he talks about stops. You are exactly right. That's a great thing to pick up on. We are using looser stops. We've actually talked about that for the last couple of months, that because of the volatility, and volatility comes in two ways. One is intraday volatility. So a lot of people, when they think about volatility, they think about ATR. That's like the intraday daily volume. But more important than that is trend volatility. That's volatility over in trends. And you can see, if you're trying to ride a trend with a very tight stop, even if that trend went from 23 to 39, you're going to get chopped out and you're never going to get to participate in that trend. So with the increased volatility, you do need to loosen your stops. That's a good that you picked up on that. Now, because you're increasing the width of your stop, that means you have to position size a little smaller, which it's always nice to be able to position size a little bigger, but then your risk is going to get too big. So you do have to position size a little smaller, but it's worth doing so you don't get chopped out of really good trends. All right, Khan would like to understand the logic on ETFs in the last day. I'm a little confused about your question, Khan. Why don't you go ahead and email me, and I'll try to give you an answer on that. When you're talking about ETFs and X was a stock, and then you're talking about Powell and a few other things, which don't even relate to what we were thinking about here. But go ahead and email me, singjD1@aol.com, and I'll try to answer your question. Prakash CLDR wants to know my thoughts on that one. I've never traded it. It is in software application, a really strong sector. Cloudera, I'm assuming just from the name and the fact that it's in software application, that it's cloud-based, which has been very strong. Even within software application, anything related to cloud-based stuff because of all the work from home is a spot you want to be looking at. So if we think about what we talked about, the lesson today, we talked about where are these stocks at? Is it a high? Is it a 200 moving average? Is it bottom formation? This is obviously relative strength. So thinking about this stock, we have relative strength. That's fantastic. It's in a good spot, software application. So that's really good. We have a great accumulation pattern. Look at all this big green and all the small red. So definitely a stock that I would have on my watch list. It's not on mine because at some point you kind of have to pick your poison. If I've got 15 different software application stocks. I've got to narrow it down. I don't need to watch every one. So I'm not watching this one, but definitely it is one worth watching. In terms of an entry right now, I think it's a little extended. So it's tough to enter here and get a good risk reward, but definitely one to watch for a setup that might be emerging. Rafe is asking about Fibonacci extensions. I don't trade Fibonacci's. So yeah, that doesn't have any application to me. That's not to say that it doesn't work, but there's a lot of different successful strategies in trading. You have to gravitate towards what works for you. And I've experimented with almost everything, and for me, I didn't get much of an edge using Fibonacci, so I don't use them. Khan, what's going on? I think you asked that question about X. Go ahead and email me about that one. I'll get back to you tonight or tomorrow. Okay, Ramu is asking, how do you enter the plays you just talked about? For instance, if a stock breaks the 200-day moving average, I've also heard that they retest a lot. How does the retest happen? I don't trade the 1 hour time frame for swings. I do, I might for like a really aggressive 2 to 3 day hold, but for a standard swing, I don't care about the hourly time frame. But you're specifically you're asking about the entry point, say on 200-day moving average. So this isn't all in a vacuum. So I use a top-down approach to trading. First, analyze the market, as you guys have already seen. We've been talking about. Then break down the sectors, and more recently, we're doing more of this kind of breakdown rather than sector breakdown. But essentially, it's breaking down areas of the market, and then from there, I'm looking at the stocks and then the setup. So it's this top-down approach. So all of these things are kind of aligning. And then when my setup is triggering, I have things to think about. How strong is that stock? Is that stock in a good area? Is, like we just talked about software application, I always want to know what area that stock is. So when, say, CLDR is breaking out here and I see it breaking over the 200-day moving average, I would know, okay, it's in software application. This is probably going to be a strong setup. I want to know how extended it is going into that setup. If it was coming from way down here and was super extended, I might not take it. So there's a lot of factors that go into it outside of just saying, okay, it's a 200-day moving average break. And then there are setups related to that too. We're not just trading 200-day moving average breaks. We're actually trading bottom formation continuation patterns. So it has to fit that overall pattern when we're looking at it. Okay, Pragnesh is asking, how do you play out the technicals with coronavirus plays as they're going up when unemployment rates could change market direction at any time? Yeah, you have to take if you're focused on unemployment rates and all the news and all the terrible stuff that's going on in the economy right now, you'd be hamstrung through this whole kind of bull market that we've seen right now, and you wouldn't be trading. You basically have to ignore the news and focus on the price action, or not necessarily ignore the news, but know what the news is, but then ask yourself, how is price reacting to that news? And as we've seen here with the market, it seems really illogical because this is a horrible, economy right now, but we don't care. We're not trading the economy. And remember this, we're not trading the economy, we're trading the stock market. And the stock market doesn't really care about the economy right now. They're thinking about the future. So I can't be thinking unemployment sucks and we could have news tomorrow that changes everything. I have to trade what's in front of me. So don't focus on the economy, focus on the market. And I think that'll help you with some of these plays. Manish is asking, what do you mean by high for the stock? Is it the lifespan or time frame? Good question. Yeah, if the all-time high was in 2012 and that's way, like say, let's just take BA is a good example here. So where do we consider the high for BA? Really, you have to think about one, the stock itself, and maybe it has an all-time high way up here at 443. That does not, I don't really care about that. When I'm talking about the high right now, it's the time frame of where we're coming from. So the high that's important to me right now, and this may correspond with all-time highs, but for some stocks. But right now, the important high is where the stock was before the big meltdown. So that when I was talking about highs here, that's really what I'm focused on. Where was the stock? And it may be the stock's all-time high. It may not be. For BA, it's not. But this is the high that's important to us right now. And then later on, there might be other highs that are important. But right now, this is the high that's really key for us. All right, Corey wants to know about SWBI, Smith & Wesson. It's fantastic. So this one was interesting, I guess because of the fear in the market and the idea that people had to protect themselves from others, or maybe even from the government if things got really bad. People were buying guns, and it's done really well. I never put this in my Corona list, but it definitely could have been in it because it handled the big drop very well, has shown a lot of relative strength, is super extended right now. So I think it's a tough spot to enter. Corey's saying that earnings were great, so this was probably, I'm assuming this was the earnings breakout here, and it's run ever since. So fantastic stock, extended right now. I would even potentially, even though this is a great stock and great accumulation, for a really quick swing, I might even be potentially looking at this as a runner short, but overall a really strong stock. All right, Naveen is asking, where would you put your stop loss for the trades in all three categories? That's not necessarily the category. You have to look at the stock specific. Basically, when I think about my stop, I'm thinking about a few things when I think about a stop for a trade that I'm entering. One, I think about where is the logical place to place that stop in terms of the pattern. So for example, if we were just looking at SWBI, since I have that up right now, let's just say, I don't think this is a good entry here because it's just way extended, but let's just pretend we decided to enter here at 1872. If I was looking at this, one of the logical spots would be under the 9 EMA. This is obviously a support level here. Or you could go under this range here. This is support level here, and that's where it broke out of this range. So think about where it makes sense on the stock, but that's not it. So first you're thinking about where it makes sense on the stock, and then after that you have to think about your own risk. If I put a stop here, what's my risk reward going to be? If I think this thing can run up to 20, can I get 2 to 1 if I place my stop here? Can I get 2 to 1 if I place my stop here? So basically think about the stock and then think about your own risk, and that will help you decide where to put the stop. Jeremiah asks, I noticed that you moved away from sector analysis and have been using a different strategy. Yeah, so if you've been with me for a few years here, you know that almost every day we talk about sector analysis and what industries are in play. And as we've been talking about today, that's changed a little bit because the market is moving in these different directions and different areas where these groupings are more important. So in a sense, I'm still doing the same thing. I'm just lumping my grouping differently. So it still is kind of a sector analysis, but we're grouping it like this instead. That being said, we still are doing sector analysis. I still will look at, okay, retail stocks. How do I break down the retail stocks? How do I break down oil and gas stocks? But there has been a move, a little shift recently, just because of the function of what the market's doing right now, to these big blanket areas rather than, like, for instance, I'm not looking at casinos. I'm looking at casinos together with restaurants, with hotels, with certain retail, and lumping that all as one big group. AB is asking, do you use level 2 when timing swing trades? I do not. I don't think it really means much for swing trading. It can help you with your day trading, but even in my day trading, I don't use level 2 too much. How important is stochastics in swing trading? Well, as you can see here, stochastics are not on my chart. I do have another chart layout where it is there. Part of that is experience, that I don't need an indicator to tell me when something is extended. I can look at SWBI and know myself it is very extended right now. I would say as a beginning trader, it can be very helpful to have an indicator like stochastics there to help you as a guide for what is overbought and oversold. Dallas wants my TC2000 template. You messaged me on Discord. What's your Discord username? I've responded to just about everybody who asked for my templates. If you didn't get it, there were a few people who I sent it out to, but for some reason it didn't go through. So send me a message again, either through DM me on Discord or just email me and I'll get that out to you. Mark B, go ahead and email me about that stock. Devin wants to know, go over what I'm watching with BBBY. Very simply, a break of the 200-day moving average. So I actually like the setup here. So beaten down, was crushed, as a lot of retail was during the big meltdown, has put in the bottom formation here, is breaking out of that bottom range now, and is now right at the 200-day moving average. If the 200-day wasn't this close right now and could act as the stronger resistance, I might even be in it right now. And look at all this great accumulation here. So obviously it's being accumulated by the institutions as it's been running up here. So I really like this stock, but now I need to wait for it to cross the 200-day moving average. But say next week it were to cross the 200-day moving average, I definitely would consider an entry here. And risk reward would be really good. Let's say it came up here to 1130. I could maybe use a 1-point stop, put it at 1030 under the 200-day moving average, get a little room for volatility and maybe a retest. But I could have a target up here at say 16, not even at the high here, but say here 1650. If I entered 1150, I'd be basically risking $1 to make 500. So make five. So think about that. If I had 100 shares of it, I'm risking $100 to make 500. And if you have that kind of risk reward over time, you're just going to crush it. What's going on, Chad? Chad just said hi. Greg, you're asking about holding times and results. Generally, most holding times are between a few days and a few weeks. Occasionally, I have a stock that I'll be holding for a month, month and a half. But most of them come in, 4 or 5 days to maybe a couple of weeks. If we're riding a trend, could be longer, or if the stock hasn't really moved the way we want it to. But basically, I'm setting a stop, setting a target, and letting it play out. I don't really think too much about how long I'm going to have to hold it. But they generally fit within that range. Navneet is asking what type of return I target on a monthly basis. I don't think you should ever have monthly goals in terms of return, especially for swing trading, because different markets are more conducive to different amounts. And with swing trading, you might go through a drawdown that lasts a couple of months. So I don't really have percentage goals on a monthly basis, or even number of trades type goals. So there are some months, maybe the market is range bound and I'm not seeing a lot of good setups. And for 2 months, I might take 10 trades. But then a month later, I take 25 trades in 1 month. So that's part of the skill of being a swing trader, is you really need to know, okay, this is a really strong market. I'm in a really good spot. This is where I push it and I take more trades and I allocate more of my account here. And there are other months where you say, you know what, this is not a good market. I'm only going to trade 20% of my account. So there is no blanket statement. I'm trading this much of my I should be trading this much of my portfolio at this time. And then also part of it is overbought, oversold. A good example of that is through this period here, when the breakout started here, we started trading. Well, this relates to SPY, but let me pull up SPY. When the breakout happened here, we got really aggressive. As the market got overbought, we started to trade a little less. And then now we're starting to trade a little more again. Sean asked, do we log trades, wins versus losses? Yes, we have a spreadsheet in the group mentorship sessions. We go over it, and then we have a chat room here, and all of the alerts are here, and they never leave. So you have access to all of these alerts here, and then the spreadsheet we go over every few months. Juan is asking the link to the earnings class. If you're a Bulls member, you'll get an email for it, but it's Bulls on Wall Street earnings-swing-course, and you can take a screenshot right here. Here it is. Sylvina is asking, when's a good time to sell a stock? So one, you should always have a plan before you enter. You're thinking about your risk, you're thinking about a reward. I never enter a trade without a plan. So I know where I'm entering, I know what the setup is, I know what the market is doing, I know what the sector is doing. All this goes into, basically all the work goes into a trade before you make the trade. Once you make the trade, that's when you basically do nothing and the work is done. And that's the opposite of what a lot of traders do. A lot of traders seem to not think too much before the trade, and once they get into it, they're stressing over the trade. And really, it should be the opposite. So you have the plan, you know, okay, my stop is here, my target is here. Now, how are you coming up with that target? Again, a lot of the factors we talked about before. What's the volatility of the stock? What's the past history of the stock? You know, how does it tend to move? Where is the resistance level? That's key. Unless you're at all-time highs, where is the resistance level? So all of these things come into play. And then what's the market doing? Are we in a strong trending market where I expect it to go really high and I can let the stock run more? Or are we in a more range bound market where I should be taking profits quicker? So all of these factors go into when to actually get out of a stock in terms of when you're winning. When you're losing, it's based on risk and where it makes sense to get out of the stock related to the setup. Okay, Gabriel is still in AA, which is an aluminum stock. And yeah, it looks like it's held up. Industrial metals have been hit pretty hard. AA held up pretty well and was actually green today. So yeah, very good in terms of maybe not overall relative strength, but you know, more recent relative strength considering stocks like CLF got gapped down today, FCX. Different areas. This is copper, that was steel. Let's go to Cenex, which is also aluminum, and that was down as well. So yeah, AA is showing recent relative strength in that metal space. Steven's asking, if you're fully invested, but you see a stock you like, what would you do? Well, if you don't have any more money, there's not much you can do outside of, you don't want to micromanage too much, but if there's a stock that you're in that's lagging, you can pair that off and get into that new stock. Sometimes what I'll do is I'm sitting on a stock that has a lot of profit and I feel like this other one is a better opportunity. I'll go ahead and grab that profit as long as I've already got 2-to-1 and then replace it with the stock that I like. Be careful though, that's a slippery slope into micromanaging and just jumping back and forth into stocks. And if you'll find that if you keep jumping back and forth, because the grass is always greener, you always think something's better. But if you do that, you're going to be in quicksand and never really make any kind of big moves in your account. So occasionally you can do that, but I wouldn't do that too much. Wow. All right, guys. This is amazing. You guys have a ton of questions here. Looks like I've got about 60 more questions. I'm going to try to just run through a few more of these really quick. I'm going to skip the ones that are related to just analyzing specific stocks. If there's one that you really like that you want me to go over, email. So I'll get to anybody's question, but some of you might have to email me. So if I don't get to your question, email it to me. And that's, you can take a snapshot here, singjd1@aol.com. You could also DM me on Twitter, Instagram. If you're a member, you can DM me on the Discord chat that we have, or just email me. But let's try. So I'm going to skip the ones that are asking for analysis of a stock. But if you email it to me, I'll get back to you. And if I accidentally miss your question, just email it to me. Do you pay attention to buy, sell, hold, and analyst recommendations? Krista, I think you're a member, so you've probably heard me say the term idiot analysts, and that is what I think of most of that stuff. But the fact is, because there's so much manipulation, and a lot of times, Goldman Sachs analysts might come out and put a downgrade on a stock, but they really like that stock and they just want to buy it at a better price. So you have to be really careful about that stuff. None of that stuff goes into my analysis of whether I like the stock or not. But what we do have to pay attention to is how is price reacting to that. And one of my favorite setups is when a stock gaps down because of especially a good stock that has been trending, and maybe its revenues are good, all that kind of stuff. Like say if Amazon's doing great. One analyst from maybe Morgan Stanley comes out and says this is overvalued, and because he said that or she said that, the stock gaps down. It's usually an overreaction. That is one of my favorite gap down reversal setups, and I'll look for the gap down reversal. I won't blindly enter just because I think it was ridiculous that it gapped down, but then I'll wait for that setup. So in a sense, we do pay attention to it. I want to know why it's happening and that there was an analyst recommendation or it wasn't recommended. But then we're going to follow our normal setups after that. Steven's asking about remounts of moving averages. I love remounts. So I like remounts better than, if you have a stock that's, let me draw this out. Well, actually, we'll just do it here. Like say one of the stocks that we were watching around the 200-day moving average. Twitter's already above it. Let's look at Twitter. Let's say, no, let's actually go to BBBY, back to BBBY. So here's BBBY. You guys know we're watching this for a potential break of the 200-day moving average. Now, let's say it broke that level and then went below it. That's actually one of my favorite setups when it remounts that level, because what happens here, have you ever heard of the term shaking out the weak hands? And that's what it does. Basically, when the stock gets above the 200-day moving average, there's going to be a bunch of people who are going to enter and have their stops right here. Oftentimes they're stop gunning, and all of these guys will get stopped out. Then when it breaks over that level again, it'll make its big run. So I do really like remounts, or especially around these moving averages. Parimal is new to trading, is asking about FinViz and stock screens. FinViz has a really good stock screener, and it's free as long as you put up with all the ads and pop-ups and videos they have. But it's pretty good for a new trader. Now you're asking for screens, specific screens. I mean, it depends on what you're looking for. There are a lot of screens. If you're looking for a 200-day moving average, for what we're talking about here, you could run a screen for stocks that are near highs. One screen that's really good for stocks showing relative strength is do a screen where you take the 20-day moving average and do stocks that are, say, 20 or 30% above their 20-day moving average. That will give you the relative strength list. A lot of stocks that are showing relative strength will show up on that screen. But I mean, I can't answer that now. There's just a ton of screens you could be doing. But if you wanted one right now to find relative strength, take the 20-day moving average and look for stocks 20 or 30% above that moving average. That'll give you relative strength. Bruce is asking if I day trade. Yes, I do. My focus, with bulls and everything I do here is swing trading. But if you're interested in day trading, bulls is fantastic. Kunal, who I mentored in swing trading, gravitated toward day trading, and he's an amazing day trader. So definitely look into that. And again, there's a lot of questions about specific stocks. Go ahead and email me about those. Pragnesh is asking me about RSI. I use RSI. I prefer stochastics, but basically you can use RSI as an overbought, oversold indicator. Now, most standard software, they're going to have RSI set to 14. If you're a swing trader and your hold times are a few days to a few weeks or even a month, I would switch the 14 to 5 because 14 is too slow. So Shivaraj is asking, is in UK and wants to know if you can trade US options out of the UK. Obviously, I'm in the United States, so I'm not experienced with that, but I work with a lot of UK traders and they're all trading the US market, so I think you should be able to. Email me and I'll hook you up with someone who trades in the UK. Lee is asking, he keeps missing entry points on shop. Going forward, how do I find another entry point? One thing, Lee, that I really like about what you said is it sounds like you're not chasing. And even though I know you're probably kicking yourself right now that the stock has gone up, that's a really good habit that you're not chasing because you missed your entry. Part of it was there were some tough entries here. You're probably waiting for a remount here, but then when it remounted, it was too far above the 9 EMA, so you weren't getting good risk reward. So that makes sense. What would I be looking at now? The way I would analyze, and we use adaptable approach where whenever we look at a stock, we look at scenarios. And the two scenarios I would look for shop. One, if it starts to run like crazy, I would look for a potential runner short. If it pulls back here, I would watch for a pullback to the 9, and maybe you get a good entry there. Khan, back to the X. So Khan had asked about X, and I wasn't sure what he was talking about, but we had entered X a couple of days ago, and like the day after we entered, they surprised us and said their earnings weren't going to be that good. So generally, we don't enter a stock if earnings are going to be in a week or two, and earnings were not scheduled for August, but out of nowhere they came out and gave guidance on earnings. So there's really nothing that could have been done there. If I had known they were going to come out and talk about earnings, I wouldn't have entered. So as a swing trader versus a day trader, surprise events are going to happen that you can't really account for, and you just have to deal with. It's going to happen. If you take 100 trades, that's probably going to happen, at least 7 or 8 times out of 100 trades you take, where there's some kind of news event. Sometimes it's a happy accident and the news event is good and it works in your direction. Sometimes it doesn't, but those things can't really be predicted. So I think in your question, it sounded like you were trying to backtrack a news event to it, but really it's something that just can't be predicted. Gareth is asking, for swing trading on a daily time frame, what is the best for researching and finding the best place to enter a trade? So there's a lot that goes into that. And we could talk for the next really 20 or 30 hours. I mean, we have a course all on that. But if I were to break it down really quick for you, what you need to do is that top-down approach I was talking about. First, analyze the market. That's going to help you set the trend of the market, give you a general idea what's going on. It's going to tell you, if you should be shorting, if you should be going long, what types of setups you should be trading. Then analyze the sectors. And we broke it down today rather than sectors into those 3 areas that we talked about. But generally, I'm looking at sectors. From there, I build my watch list. So I think that's more about what you're asking. Then we build from there. So you can see that top-down kind of triangle. From the sector, we had the big market. We broke it down into sectors. Now we have from the sectors the stocks. I also have some scans. I don't do a lot of scanning, but just simple 5% breakouts, breakdowns, overbought, oversold. That's going to clue you in on most of the momentum stocks and also our sector analysis. If you've done all that, basically just about all of the stocks that are important and are in play in the market, you're gonna be on top of. From there, now we have that watch list of stocks. We're looking for specific setups. So it's kind of that tiered top-down approach. And once you've got to the setups, now you're narrowing it down to, okay, this is where my entry point should be. This is where my risk should be. This is where my reward should be, and what kind of position sizing you should be taking. Manesh has a good question about where do you take your target if a stock is at all-time highs. So if you've got a resistance level, like let's compare SHOP with what we were talking about before, BBY. BBBY is very easy in terms of your risk analysis. You know, you're going to enter here, say at 11.25. You know your stop should be under the 200-day moving average, and then you can look at resistance levels. There's an open gap here at 14. There's another high here at 16, and there's a big high here at 18. These are all areas you can think about, and then think about the volatility of the stock. Can it reach those ranges? So very simple to assess where your potential reward is. SHOP is a little different. SHOP's at highs. We have nothing above us to say, okay, there was price action here. This could act as resistance. I should get out at that point. So how do we assess where we place our stop? The easiest thing to do is look at the past history. The past history is going to clue you in on its volatility. So if I'm trading SHOP and I enter here at 863, I know the last time it broke out of a range here, it went from 659 to 830. That's 150 points. So just knowing that, I could say at 863, there's potential of this thing to run to 1,000. Whereas maybe if it was a slower stock in a tighter range and I was entering at 860, that stock's previous history might say it could only go to 900. So one of the biggest things is look at its recent past history. That'll clue you in on the type of moves it can make. And then we get into other things like float size. Right? Is it a real heavy stock? Is it a lighter stock? How much volume's coming in? What kind of short interest is in that stock? I mean, there's a ton of other factors that play in, but the quick, easy thing to do is look at the past history of the stock. Pragnesh is asking for, do I look at VIX levels? VIX levels have no impact in my overall market decision. When the market is dropping, I do watch VIX as a fear indicator. I might even trade it. But other than that, usually it's not coming. The only time it's coming into play is when the market is tanking or pulling back hard. Okay, and again, guys, all of the requests about stocks, I'm skipping those. So go ahead and shoot me an email or a DM. Okay, another question about VIX. Pedro's asking, with coronavirus cases rising again and unemployment being a problem, do you think the market can crack right now? Crack, I'm assuming, meaning to the downside. That's definitely a possibility, and that's been a possibility through this whole run. So it's something you have to be thinking about, but again, you can't predict this stuff. At the end of the day, follow the price action. I mean, and the market doesn't move logically, so we can't use logic. We just have to follow the price action. I mean, if I was using logic right now, I would think the market is tanking, and yet we're near all-time highs, right? Unemployment is at record highs. Corona cases are increasing. So if I was just thinking to myself what I should be doing right now, I would be heavily short, but I'm not. Because even though I think that, what is the market telling me? The market is telling me something completely opposite. Now, if the market were to start putting in patterns that tell me, and market breadth indicators that are telling me that I should be shorting now, I would definitely do that. But until it does that, I won't. I'm not going to consider the news. I'm going to consider what the market's doing. I love Peloton, David. Almost entered it today. But if you want more analysis, shoot me a message. Okay, a lot of questions about how I find my swing trades. I think I've answered that in general about that top-down approach. Greg is, this is really a good kind of philosophical comment here that sounds like we are examining human psychology, and that's really true. The market is like this big, almost psychology experiment. And a lot of what happens relates to not only there's specific psychology in terms of how you trade as a trader, but there's this kind of group psychology, and that is why, you know, we've been hearing this for years, that the computers, the technology, the algos, all the classes on trading, that all of this is going to change trading, and the computers are going to take over, but it hasn't happened. If you look at what's happening now in the market, it's the exact same stuff that happened over 100 years ago. There might be some minor differences, especially in day trading, but overall in investing and swing trading, very little has changed. And in that bear market class that we did about a couple of months ago, we were talking about that you might think that things have changed now because of technology. We're supposed to be smarter. We've got all these computers. We've got algos trading. But the exact same stuff that happened in 1918 when there was the Spanish flu pandemic, exact same stuff is happening right now. Not only related to the market, but related to how we're reacting to this flu. Same thing is happening. So it's all psychology. We never change. So you're right about that. Stephen, okay, I think that's the same question as before. Okay, Amin is asking, as a new swing trader, I'm struggling with planning and entering trades with a longer term time frame in mind. I'm guessing you're coming maybe from a shorter term time frame in the past, and feel more confident with shorter time frames, specifically in this crazy market. For example, BA, I entered with my target at the top, but exited quicker. You know, if you're swing trading and you're not doing a very quick strategy, you have to be careful of that. You can't micromanage positions. It's one of the biggest mistakes swing traders make, is micromanaging positions. You make the plan, and you have to have this set it and forget it mentality. You know, this is my target, this is my stop, and just let it play out. Don't watch every tick when you're in the trade. If you do watch every tick, you're always going to get out before the big move, because it's very rare for a stock. Like, let's just look at, I mean, if you were trading SPY here and you entered, say here, and you at 264, and your target was the 200-day moving average at 297. It's very rare, almost never, that the stock is going to go in a straight line to that target you planned for. You know, this gap down might have been a little scary for you here, but you have to stick with the trade. I'm in an example of that is I'm in BYND right now. I'm in BYND right now, and our plan here is to, you know, we got in at 137, and my plan is to go for a really big win here. Look at this great accumulation here. Stock's been on fire. It's showing relative strength. I think there's a lot more room to the upside. So I'm trying to hold to at least around 190. Now in that time, it's gone from 137 to 158, which is fantastic. And there have been a ton of our members who haven't been able to hold through. Every little gap down, every inverted hammer here is an excuse to get out of it. But if you continually do that, you are never going to participate in the big moves. So I would say, for your question specifically, you have to have that set it and forget it mentality in mind. Know where your stop is, know where your target is, and just let it play out, let it go. Namrita is asking, is there a good indicator for price volatility in TC2000? There's not a great one, but there is one called actually price volatility. The problem with that is it's measuring, like, you could have a stock that, say, doesn't move at all. Let's say if it was at 125, if it went down 10 points, went up 10 points, and then ended up at 125, it would show up as a very volatile stock. That's not what we're really taking it into account in terms of trends. We care more about trend volatility, which is, you know, how fast it's moving. So you can use that as a guide, but part of it is just analyzing what's going on as well. Yeah, but there is one called price volatility. Ruben is asking, what platform is best to trade on? You basically have one of three choices. You have a retail broker, you have a direct access broker, and then you have brokers that are kind of in the middle. Retail brokers tend to make money off your trades, meaning when you put that trade out there, it gets exchanged a bunch of times, and by the time you make that trade, you're usually not getting the best price. For swing trades, it's not as important. If you're day trading, it's very important, and you should be using a direct access broker. I love interactive brokers. It's kind of the happy medium between the two. You get really good executions, and also they have access to a lot of the hard to borrows, and the fees aren't that high. So I like that, but there's a ton. You'll probably have to look into what's best for you. Khan, who is a member, is asking. I was considering Peloton earlier in the day, and then you chose work. Was the setup better? I don't think one was better than the other. They were different setups, and so let's just look at them. So Peloton, I love Peloton, and I might enter it tomorrow here on the break of 50 here. We've been talking about this. This has been consolidating for a month, and we want to get in above 50. I think that now it could make a really big run. And I had narrowed it down between Peloton and work, and I specifically went with work because I like the fact that it's a setup I was looking to trade. Because remember, when we talk about non-correlation of our portfolio risk, we want different setups. We don't want to all be trading one setup, because now if that setup doesn't work across the board, probably you're going to get stopped out of all of your trades. So for example, Tesla is very similar to the setup we're trading with Peloton. I've already got like 3 stocks I'm in showing this setup, so I wanted to balance that with the gap down reversal. So that's a lot of what factored into it. But if you're just specifically looking between the two, I don't think one is better than the other. They're both great setups to trade. Ahmed's asking my thoughts on casino stocks. I've alluded to that already. I love them in terms of bottom formations, MGM, Win. You're mentioning Erie. That I haven't been watching Erie, but that sounds like a good one too. It's actually better. Yeah, I like this one that it's at. This is basically 200-day moving average. So if it got up over the 200-day moving average, I think you'd have a good setup here. Ramu's asking about Apple. I'm not doing tickers, but since everyone's watching Apple, let's take a look at it. Apple has been showing relative strength, specifically within the FANG. It's one of the better FANG stocks. Tough entry here. It's very extended. But if it were to pull back and then show some strength, I think it'd be a good entry. All right, guys, there's still over 100 questions here. Go ahead and do this. If I didn't get to your question, shoot me a message. I'm going to leave this up for a few seconds here. Again, singjd1@aol.com. You can email me. You can message me on Twitter, Paul J. Singh. And then you can follow me on Twitter too. I post a lot of stuff on Twitter. I post to stories every single day on Instagram, at least 3 or 4, talking about the market, and I have my TC2000 up, so you can check it out there. And then if you are not a swing member, go to bullsonwallstreet.com and then part-time swing trading. You have the access to the course here. You have all of our past mentorship sessions. There have been 31 so far, and there's not only it's question and answer, but with everyone, like today, there's a lesson. So it's essentially adding to like a bunch of classes in there as well. And then there is the chat room here, and then you can DM me here as well within the chat room. All right, guys, this was a fantastic session for Bulls Swing members. We're going to have another group mentorship next week. Again, for those of you who are not members, message me anytime and I'll get back to you. And if I didn't get to your question today, shoot me a message and I will definitely answer it. All right, guys, fantastic session. I'll talk to you guys soon. And let me pull up if you need to take a snapshot here, the new earning course right here. And here's ways to get a hold of me. All right, talk to you soon, guys.